The issue with the AMD is this dilution. Just remember this. I actually just want to avoid AMD. That's the killer for investing. Just because the company is growing, it doesn't mean you should buy it. That's the big key with AMD. I hope that was a good eye-opener for you. This is amazing. Guys, the chip business, the chip industry has a lot of growth potential, and there's a lot of big players. Intel is one, and everybody's down on them. AMD is the up-and-comers. So this video is about AMD. The question is, I want everybody to ask, just because the company is growing, it doesn't mean you should buy it. The question is, how much do you pay for growth? That's the big key with AMD. So let's pull it up. And if you're watching our video for the first time, you've got to remember this will be confusing. It's okay, because we're trying to teach a process. And processes that really stand the test of time take a lot of shift in how you think. It took me a lot of shift. I used to believe in just buying growing companies and exciting industries at whatever price by buying the stock, because hey, this thing has a lot of growth potential. That's not the correct way to do things. So watch the video, subscribe if it makes sense, rewatch the video, rewind, watch forward. It doesn't matter to me. The point is, we're trying to teach a process of investing that has worked for decades and decades. We're buying a stream of cash flow. So look at AMD here. Now here's the interesting thing about AMD. You go back to 2000, and its high was, I don't know, 45, 46 bucks. It's currently at $67. So 45 to 67 is 50% growth over 22 years. 22 years. Now, here's my point that I want to get to you about it. When you buy a growing company, you should still be aware of what you're paying. So here's my point. In the last 12 months, AMD has done $22 billion in revenue. Okay? Just remember this. $22 billion in revenue. Let's go back to 2000. In 2000, it did $4.6 billion in revenue. So 4.6 to 22 billion. What is that? Almost 5 times, like 4.5 times, probably a lot more than that. If I told you in 2000 that AMD was going to have 4.5 or 5 times more revenue 22 years from now, and the stock was at $45 at that point, where would you have told me the stock was going to go? And I pause there because this should be the absolute first thing you think about when you go, wait a second, there's a disconnect there. Let's look at profit. The company made $1 billion in profit back then. In the last year, it made $1.4 billion. Now that might have been a little bit of a, because if you look at the previous year, it was like $3 billion. So you sit there and go, wait, it had more profit, it had a lot more revenue, and the stock's only up 50%. Where's the disconnect? Now, somebody out there might say, well, the stock is beaten down. Look at it. The all-time high was 165. Now it's at 67 and hit a low of 54. No, what matters is, in the short run, a stock is a voting machine. Very popular. In the long run, it's a weighing machine. What's behind the company? That's what matters. When you overpay for a good thing, even for a growing company, if you overpay, it will still suck. Do I believe you should overpay? Absolutely, in certain situations. With a high return on invested capital, and there's still a reasonable level of overpayment. The question is, how much is enough? The problem we had here was any price was a good price. You sit there and say, no, that's not true. Yeah, that's what it is. If you're just buying, that's how parabolic rises happen. Look at it recently. Look at this parabolic rise. All right, so let's go look at some metrics here. Gross profit, 45%, pretty solid. Return on invested capital, 15%, pretty solid. I like these things. And AMD makes a really good chip. AMD makes a great chip. But again, it's possible to overpay for a good thing. Look at a Ferrari. If I told you you have a Ferrari that sells normally for $305,000, I'm going to tell you, hey, pay me $1 billion for it. You'd say, of course not. Why not? It's the best sports car out there. Pay $1 billion. You might sit there and say, that's a ridiculous analogy. It's not. If you understand the fundamentals of business, and when you see what happens in the stock market, when people just pay whatever it takes to own a company, that's how these prices come up. It's because everybody's like, I got to get in on this. They don't look at the fundamentals. Investing became a lot easier for me when I understood that when I buy a stock, I'm buying a piece of a business. And when you buy that piece of a business and you pay a reasonable price for it, you will do well as the company does well. There are 3 questions I always ask. First one, do I think this company will be around for the foreseeable future? For AMD, I do. 2, do I think they're going to make more revenue and profit in that foreseeable future than they make today? For AMD, I do. The third question, and the hardest one to say yes to, is, can I pay a reasonable price for the company today that factors in that growth where I can get an adequate return on my investment? That is the one you'll probably say no to. You should probably say no to 95% or more of the time. You're only looking for the obvious right situations. So what's a reasonable price for AMD? Well, let's look at their 8 pillars first. All right, look at this, guys. Here's the problem with AMD. One big problem is, yeah, their profit might be up 150, 200% in the last 20 years, but just in the last 5 years, they've increased their shares by 64%. Where were their shares? Their shares 20 years ago. They currently have 1.6 billion shares. 20 years ago, it was 300 million shares. That is, oh my God, look at that, guys. They have 5 times more shares now than they did 20 years ago. So even if the company grew 5 times, you saw no benefit as an investor. This is amazing. This is the silent killer of investing. Nobody pays attention to this. But this is why this is so important. They've diluted everybody along the way. Even though their fundamentals got better, and even though the profit got better and everything, they diluted everybody. They added so many partners in there that you didn't see any extra benefit of that. That's the killer for investing. That's what sucks. You've got to be careful of that. That's right there is, I love that. Please watch this again. Go back and look at that. Understand that. If there's a company with 10 shares, let me show you exactly what I mean by that. If a company makes $10 a year and it has 10 shares, each share gets $1 of profit, right? Very easily. $10 per year divided by 10 shares. Let's say 20 years from now, it makes $50 a year. But it also now, they've issued 40 more shares. Look, there was no benefit to the shareholder who owned back here. Even though the company went up 5 times, their number of partners went up 5 times. You saw no extra benefit. That's what happened here with AMD. They have 5 times more partners, and they don't even make 5 times more money. That's the problem. I'd make the argument that AMD was a better investment in 2000 than it is today. That is absolutely incredible. I didn't even realize that. You learn something as you do these things. All right. So let's look at analyst estimates here. All right. They're expected to make $3.69 a share this year. And in 3 or 4 years, if they don't dilute the heck out of everybody, they're expected to make $6.50. Some decent growth. Again, these are analyst estimates. Take it for what you might take from it. They tend to be overly optimistic when things are good and tend to be overly pessimistic when things are bad. Let's go to revenue growth. Not great. 25 billion to 31 billion, which is interesting because I read a report last year that the chip industry had a 12% growth rate for the next 10 years. So that seems kind of low here for AMD. Now, let's go to our stock analyzer tool. So the issue with AMD is this dilution. So for me, I immediately think to myself, I actually just want to avoid AMD because of how much they dilute their investors. It's over double in the last 12 years. I get it. I understand why they're going to do that because to me, what that tells me is AMD thinks their stock is too expensive. They're like, hey, everybody, it's too expensive. Why take on debt? We'll just issue shares because everybody loves our shares. Man, wow. They don't, look at that. Look how low it got here. $2.61. Well, $1.83 in 2016, the year the Cavs won the title. Man, guys, I'm not going to lie to you. I'm just out. I'm not even going to look further. I know you guys want to see the stock analyzer tool. This is a great tool for the future. It was used 1.3 million times in our software by our users last year in our community. Please watch another video about another stock because you'll see me use a stock analyzer tool. But I don't think it'd be accurate to even use that here because of their dilution. Their dilution's so bad. So bad. I just can't even deal with it. I look at it going, well, what am I looking at here? I'm looking at a company that just doesn't care about its investors. So anyways, guys, I hope that was a good eye-opener for you because I guarantee you haven't heard anybody talk about that here on YouTube about share dilution. But they had 5 times more shares today than they had 22 years ago. And their revenue and profit, their profit's not up 5 times, but their revenue is. So guys, thanks very much. Please subscribe to the channel. I hope this really made an impression on you. Take care.